Yeah, we were everyone. We were just talking about milk and cereal and restaurants that have specialty
There,
milks and cereal. Thought we'd share that anecdote before we get started. Actually, Rob, the I think the best thing I read this morning in your commentary was TSA and no shoes. I'm the I'm the oddball guy that travels every other week for work, and I'm still too lazy to get pre-check, and this kind of solidifies my laziness, I feel like.
I have steel-toed boots, so I have to take them off anyway. But for everybody tuning in, I think it's important that we let them know that Ira Selwyn doesn't drink milk, nor does he eat any food that you put milk on, aka cereal. But Ira, have you ever heard of a restaurant in New York called Mama Fuco's?
Yes,
Have you been there?
I have not.
They offer desserts that are made and the recipe call because you can buy the cookbook. You can buy a cookbook and look at the recipe for this dessert. And some of them have cereal milk included in the ingredient. You say, what the heck is cereal milk? You eat a bowl of cereal, whatever flavor you want, Captain Crunch or Cheerios or whatever. You save the milk, and that's what that recipe calls for. So that would be, and they use that for whatever. Anyway, I don't. We're not going down the mortgage path here very easily, are we?
Well,
Sorry,
I
Marcus.
I feel like for cereal milk, that'd be Ira's worst nightmare. It's the two things, sugary cereal and milk, and then combined into one aftermath.
Well, we could see, we talk about the tariffs and inflation. Do you have any feedback on the inflation in regards to cereal costs?
There we
Oh,
go. Yeah.
let me tell you about cereal costs. Ready? So I don't know. I guess they're up. The prices in the grocery stores are up, but there's two ways to raise a price. You can just raise the price on the existing box of cereal, or the craftier method would be instead of offering a 12-ounce box of cereal, let's bring it back to 11 ounces or 10 ounces and keep the price the same. The consumer has to look at the little tag where it says the price per ounce in order to figure out, gee, the price of my cereal went up. So I think, Girl Scout cookies. Hey, let's cut back a one cookie a box and charge the same.
Sounds like
Well,
some best execution fundamentals there.
there you go. There you go. All right, Marcus, come on,
Yeah.
get us back on track here.
Yeah. Shrinkflation. I like that. And the one last anecdote on that. Years ago when I was in college, when you had to submit papers with like 5 pages, you do the 12.2 font just to get over that last hump. It's the opposite, which is the opposite now because it's hilarious. Because if you think about college, you have to write all these different papers and whatnot, and you get to work. If you send me an email that's more than like 5 sentences, I'm like, man, can you just call me? Let's make this a phone call or maybe a text message
I'm
with an
out.
emoji, yeah, or something. Anyway,
Right.
hey everyone, I'm Marcus Lamb, head of sales engineering at Poly, which is the sponsor for today's podcast or
Thank you.
panel. Poly is a product and pricing engine. We have the PPE, a loan trade exchange, data analytics APIs, and an AI platform. And just real quick, some quick enhancements on our system. We have mobile lock. We've got a rate generation tool that just came out, and then MBS price interpolation. But today, this next 40 minutes or so, we are here to talk about economics and cap markets and all that good stuff. So we'll start things off today with I think the biggest data point that came out recently was the unemployment report or the employment report, plus 147,000 new jobs and unemployment rate holding or dipping down to 4.1%. I'll start with you, Ira. Like, from my seat, I don't have as much view anymore into like the immediate reaction on the street and the loan officers. Like, what was the outcome of all that on your side of the house?
Yeah, so I think there's a couple points there. So for the previous 2 weeks, we've been seeing a fairly decent rally in the market. Rates have been slowly creeping down, which is exactly what we want. We don't want that sharp decrease. And obviously whenever you have a few days of a market rally, there's no surprise to see a bounce. And obviously with the employment numbers coming in as they did, we did indeed see the bounce come the other way. And unfortunately, that bounce has seemed to continue over the last 2 to 3 days. I forgot what day we're at with the holiday. But we've definitely seen rates increase. We've seen, if anyone follows Fed futures, the quick view on the CME FedWatch tool, you would see the probabilities of a pause increase in July and September. The numbers still favor a cut in September, but have definitely come down a little bit prior to the unemployment numbers. So the holiday sort of threw a little bit of a wrench because it's been a little quiet with people still coming off of the extra long weekend. And even yesterday was a very quiet day with zero economic data. So I think today was sort of the first day where it was sort of back into full gear and seeing some sort of impact. And unfortunately, looks like hopefully not, but looks like we might be back on the upward trend into this sideways range that we've been for the previous few months.
Yeah, thanks for that. And then Rob Kessel, kick it over to you. Adding to that, like with the latest unemployment report, I mean, what is the Fed like? How big of a data point for the Fed is this? Is one of many? Is this like a primary one, or where does this sit in the stacking order of?
I mean,
Yeah.
as economic releases go, this is like the soap opera worthy release to focus on in the month, right? It's historically largely one of the biggest market movers. Certainly, this last one was just close enough to expectations and missing any material changes across the other sub statistics to where it wasn't, anything fundamentally new as far as I'm concerned for Fed discovery. The Fed still sits in this position of waiting to see how and if tariffs bump things up and if there's any more clear direction on employment. So it's a little bit boring last week, but generally this is the release of the month that people pay the most attention to.
Got it. And from like a tactical hedging perspective, I know we've talked about this in past panels and capital markets wraps, but what's the best practice going into like a big data day?
Flat, you're flat going into it and you're vigilantly watching what happens, not just immediately afterwards, but throughout the morning, the whole morning afterwards to kind of see, depending upon the magnitude of the surprise, how the market kind of sits out or how it settles down into where it's at, and then being, capable and on top of updating rate sheets as necessary if the market continues to move or moves enough to warrant it.
Yeah, I got it. Thanks. And then Rob, Chrisman, question for you. So Trump wants to cut rates. Fed Chair Powell is managing, volatility with the market, inflation. What does it take for the market to price in fully a rate cut for September?
Well, let me say something first. So I think it's important for viewers and listeners to know that it's well documented that Ira spends his days listening to Pink Floyd, Dark Side of the Moon, Alan Parsons, other tech rock. And so when his boss, Stephen Milner, walks by his office and Ira has those headphones on and Ira's like talking, Stephen leaves him alone. So it's just trying to manage his boss. That's why he wears that headset. Um, the Federal Reserve is, I will argue that oftentimes, most times, the Federal Reserve is behind the market in terms of what it does. It used to be where, throughout the history of the bond market, at least throughout my job history, nearly 40 years or 40 years actually about this month, been doing this, different things move the market, move interest rates. When I started, it used to be money supply, which would come out Thursdays. Ooh, what's money supply going to do? Unemployment was almost an afterthought. We moved to where we are now, and people used to watch the price of gold or bullion or different indices. And now unemployment's big, but it's always, when you talk about economic news, it's always, oh, what is the Fed going to do based on that news? What is the Fed going to do? And for the capital markets folks on this call, I think it's good for them to remember or remind their coworkers that the Fed doesn't set mortgage rates. Supply and demand, for the most part, set mortgage rates. And the same economic factors that will force the Fed to do something do impact mortgage rates. But the bond market tends to be much quicker than the Federal Reserve. The Federal Reserve will meet, I forget the date in July, but it's later this month. By then, maybe the bond market will have moved. I don't think they meet in August. I think they meet next in September. And a lot of money is, or bets are saying, oh, they're going to change, they're going to cut rates in September. I would bet anybody on this call that the bond market will have moved appropriately so that if and when the Fed does cut rates in September, the bond market will already be there. And it may have gotten there gradually, which would be nice. It may have gotten there drastically or dramatically, which would not be good for hedging perspectives. But the Fed, I think, will follow whatever the Fed does. It's not like the Fed says, "Oh, the bond market's here, so we need to do this." But the Federal Reserve presidents, the district presidents will have spoken. They speak every week. They talk about their indications. They talk about what's on their mind. They're talking about what they're looking at. They've done a very in recent years, several years of broadcasting what they're thinking and where they think the market is going. And so I think the bond market will react to a lot of those comments and a lot of the economic news between now and then and already be where it needs to be for the Fed to cut in September.
Yeah, that's a great answer. Thank you for that. Double
The,
backing
the,
to make
the
it better.
IRA part or the Fed part?
Well, both. I was going to double
Okay, go
back
ahead.
on both of those. First one, I believe there's a Seinfeld episode where George says the key to looking busy at work in front of your boss is you always just look annoyed. So, Ira, maybe on top of the headphones, I think, just keep looking angry and frustrated, and there you go.
You
You'll
gave up my
get
secret.
yeah. I mean, so the second thing, Rob, and I'll kick this over kind of around the horn, how to Ira, but you said supply and demand, and obviously the big news that came out is Trump's big beautiful bill, which is projected to add 3.5 to 4.5 trillion in debt over the next decade. I mean, what is that? You've got a huge sudden injection of supply. Like, what does that do for rates? And I know it's highly speculative, but just general thoughts on that.
Yeah, I mean, I guess I'll start. So, interestingly, you know, the bill and the plan has been in the works for a bit now. When the bill was actually passed, we didn't really see market reaction. And some of that due to as sort of as Rob mentioned, this all these announcements are mostly built in already. So when the Fed's going to cut, we're seeing the movement today based on the Fed's actions later. Similar to that, the bill, we didn't see any movement when the bill was actually passed, if you notice. Very, very minimal movement. I know it was sort of around the holiday, but still, the impact of, um, you know, we talk about inflation, we talk about supply and demand, and we talk about, lower revenues coming into the government. We talk about higher deficits, and obviously all that having a negative impact on rates. Definitely not what we had hoped for, right? We had hoped for some deficit reduction. We had hoped for less spending, and it seems like, unfortunately, we are not getting less spending. We are getting either equal or more spending, and we are not getting some of the cuts that we had originally hoped for. So, when we look at rates in general, one factor of of rates being deficits and spending, it's not really going to work out like we had hoped. As we go down further in the year, maybe the expectations for lower rates will be muted a little bit. Maybe we'll still remain in this, current rate environment, maybe even higher later in the year. I know earlier in the year we were all hoping for lower rates towards 25. We've been talking about that for the last year and a half, but it seems like we're still, going to be stuck in this range until we see any actual meaningful changes occurring.
Got it. Rob Castle, anything you want to add to that or thoughts
I
on that?
mean, the U.S. Treasury, it's a relative investment from other sovereign debt, and so there's a worldview, there's geopolitical stress that that always has a bid for safe haven treasuries. So it's always hard to kind of look at these things in isolation. I mean, I think also the market, although they may have priced it in, there's certain events, like, for example, a poor auction, where if a certain duration of a maturity of a treasury auction comes in where there's very limited participation, that starts to show that there's less demand. And I think that spooks the market and kind of moves the yield curve around. So all those things kind of just play into it. And it's hard, the US Treasury, it's real hard to view in isolation.
Got it. And Rob, Chris, anything you wanted to add to that?
No. You guys have all been on panels, and by the time you get to the last panelist, it's like, Rob, anything you want to add? Boy, it's all been said by smarter people than me. So
Well, that's how I feel on this panel every month. I always pray that you'll call on me last. I'm like that kid in the back of the room in class with head down and pretending to
now
be
I
busy.
think, in talking to originators, the the rates are going to do what they're going to do. And yeah, I go back to what Ira and Rob said. We're kind of in this range. We may trend a little bit up, trend a little bit down, but the originators are kind of either used to rates where they are, or are, the emails that I used to receive, like, Rob, when are 30-year rate, when are we going to see 3% again? When are we going to see 4% again? When are we going to see 5% again? Those have died down dramatically. I think that LOs and AEs and to some extent borrowers are saying, okay, rates are where they are. How can you, my in-person LO, my in-person broker, originator, whatever you want to call them, how can you help me find a product? Because I'm a self-employed borrower, or all I've got is bank statements, or what I'm trying to buy a yurt in Wyoming, or I'm going to buy some public land and build my dream house, whatever it is. I think that they are used to rates being where they are. They've gotten accustomed to it. That's not to say that rates won't move, but the hope, I've got my whole livelihood, based on rates coming back into the fives. I don't know if that's such a good strategy right now. And obviously we receive news every week, whether it's the Fed official speaking or the auction results, as we were just talking about, or unemployment, or inflation. And I think I don't, nobody expects a surprise, but I would say the relatively speaking, and Ira can address this better than I can, but relatively speaking, the news has been pretty steady. There haven't been any huge surprises per se. And so when the news is kind of steady and as expected, rates are going to kind of stay where they are.
Would you say, and this is just a general thought, I mean, would you say the news is steady today based on how it's been over the last few years, or steady if you were to use like 20 years ago as a reference point when I was barely getting into the industry? I mean, I really don't have insights into that just because I wasn't working it at the time.
Me or somebody else?
Sure. Whoever wants to take
Well,
that one.
So the news, if you really want to get philosophical here, and I'm going to get philosophical anyway, if you go back to the the people who created wealth throughout history, 1600s, 1700s, into the 1800s, got the Vanderbilts, the Jay Goulds, the Stanfords, the Huntingtons, the Carnegies. You got these people who didn't have access to the news that we have now. They weren't sitting there at their desk with a trading screen basing their moves on what was going on day to day, minute to minute in the bond market or the stock market. They were taking a longer term approach to being safe, to building wealth, to hedging their bets, to creating wealth. And I think that to some extent, the news flow that we are dealing with now, there's so much news coming at us, especially from the transition from the Biden administration to the Trump administration, where it all brings flashbacks of the Trump one, where you would wake up and what was tweeted out overnight, what happened overnight, what did Donald Trump have to say, and we're kind of back to that news flow where it's like, oh, what happened now. And I think, and Ira or Rob, you can correct me, please do, but I think bond traders and stock market traders and investors are kind of like, oh, another pronouncement by the administration. I can't trade my position based on something Bill Pulte says, or even Donald Trump says, or something that Elon Musk says, because it might change a day or two or three later. And you can't, if you're JP Morgan Chase, you can't have these knee-jerk reactions because you'll be all over the place. It'll be an incredibly volatile environment, and volatility is not typically the friend of a financial institution. I'll get off my soapbox now.
That's all good. Um, so Ira, I had a question for you. So Rob Chris was talking about email trends that he's got from LOs. Any changes in kind of like strategy with loan officers that you're seeing based on maybe the acceptance that rates are going to be where they're at for a longer period of time?
Yeah, we're definitely seeing an increase in temporary buy downs again. I know that sort of goes in and out of vogue. So that's one thing that we're seeing a little more of, borrowers that want to take advantage of that lower rate in that first year or that second year. Um, so we've seen an increase in that. We're still getting requests for ARMs. Still not seeing that market quite there yet to compete with some of the local banks or credit unions. I think we spoke about that recently on one of these calls. But from May to June, I just did a quick comparison. We did see an increase in locks, so we were up about 15% from May to June. So we are still seeing that increased activity. Now, some of that may have had to do with the little dip that we had in rates. But really it's just more of the same. It's getting back to basics for loan originators. Boots to the street, picking up the phone, visiting their realtors, visiting their real referral partners, and sort of getting back to the more older school way of thinking and relationship building. And one other point I just wanted to make. Rob mentioned the tweets. I think in a weird way, it's almost a good thing because so many people are just throwing out tweets and opinions, and like you said, traders aren't trading on those tweets. So I think it's definitely a good thing that everyone's sort of on these platforms and spewing their thoughts every 15 minutes, because it eliminates all of that noise. And you could sort of get back to actual headlines, actual news releases, and not have to worry about sort of the noise outside of those sort of items.
Ira,
Ira,
sorry, Marcus. But to add on to Marcus's question, beyond say Florida or Texas, is there increasing chatter about just property values, home price values, and which way they're going, and whether or not LOs are concerned about production slowdown, if of any of those fear sentiments?
So I haven't had any, of those concerns brought to me. I have recently read a few different, data points that were a little concerning, specifically in some areas of Florida, some areas of Texas where, you have borrowers that are upside down at this point. There was a data release in regards to borrower FHA vintage loans from 2022, how in certain areas of Texas, those borrowers are now upside down, which is, kind of mind blowing after we've been in this environment of increased values. We sort of could start to see a tipping point and are seeing a tipping point in certain areas. Now, I haven't had those concerns brought to me from originator levels, but obviously it is reflected in the overall volume that we see on a daily basis.
Hey, Rob, I want to ask you, Ira talked about buy downs. Do buy downs make economical, theoretical sense? Do you think it's a good product um, overall? Does it make sense for borrowers? It is popular. I know builders offer them quite a bit, but in your career, Rob, have you seen buy down? I mean, why hasn't buy down production picked up dramatically over time?
Well, I think when the builder is paying for the buy down, it's a direct. Well, first of all, we know that the buy down allows the borrower to qualify at a lower rate and start at a lower payment, right? And then the question is, where does the money come from to fund the buy down? And if it's builder, then builders are used to putting a lot of money into subsidizing the loan to sell their houses. But when it's a lender paid, they're generally looking for higher note rates. And one of the things that we've seen over the last 5, 10 years is this compression in coupon prices, right? Like with higher prepayment assumptions, that the difference in price between a coupon and the coupon 0.5% higher, once you get above par, that difference has tightened in the last several years. So it ends up being it's pretty expensive for a lender to find enough for the buy down. Like you think about a 2-1 buy down, that's like 3% that you have to come up with to buy that down. And doing that in the premium market means a lot of rate differential. So I think that's going to be relatively challenging, but I mean, I'm not in the front lines like Ira is. So, Ira, keep me honest.
In the trenches.
Yeah, we are seeing it more on the seller side. The lender side, as you said, we've seen some lenders and investors push their 1-0 buy down. So it's about a 80 basis points cost. So they can sort of account for that in one way or the other. But I think and I haven't done a deep dive whether it's the loan originators pushing it or whether it's borrowers inquiring about it themselves. But I've seen arguments made both ways on the viability of the product and if it's a sound investment. The one piece that I always sort of remind loan originators about that is that if that loan is refinanced or if the borrowers sell that home, the money is not lost. So that money at least does get applied to the payoff. So they're sort of not losing that money as opposed to if they were, strictly paying discount points. But I could see the argument made both ways, whether it's a good product or not a good product.
And subject to the de minimis rules and securitization as well, right? Like the 10% max within a pool.
Yes, and we've seen some investors levy heavy hits on government temporary interest rate buy downs. I saw one recently that had a 0.75 hit just for VA or FHA buy down. So that is something to consider on the government side as well.
I was going to say the fiscally conservative Asian in me would always say stick to the 30-year fix at all costs. Ira, you're talking about like trading off tweets. I was going to crack a joke there that in 10 years we'll be trading off of TikTok dances or something. With what Rob Chrisman and Ira said about just like LO behavior and activity and changes in trending. Rob Castle, back to you real quick. Are there any shifts or like fundamental changes when it comes to hedging a pipeline with that kind of change in overall sentiment?
No, I mean, I think it's the same fundamentals. You have like if using the buy down as an example, if certain products emerge from the hedging perspective, You always want to make sure you have fungible investors to be available to, to hedge and deliver that product. You don't want to have a single investor take out. That can lead to a lot of additional risk. Just you're essentially outsourcing your margin to that investor as far as how you price on a rate sheet. Um, but I think the sentiment is generally adapting to higher rates and struggling, to get every deal, and the lenders trying to keep hedge costs down and rate sheets competitive and help L's as much as they can in that capacity. But I think the fundamentals, the same blocking and tackling still applies.
Yeah,
Hey,
and
Marcus,
then
can you talk about what Polly is seeing in terms of lock trends or business trends in general without revealing any secret sauce or proprietary information?
yeah, I can share some trending data on from the Poly platform. It's actually been decently volatile in month-over-month changes. For example, like March, we saw a 38% uptick in volume over February, and then it's kind of basically all over the map. I'd say the main trend that stayed rather consistent is the purchase versus refi mix. Like that's obviously just driven by where rates are relative to where people are holding their mortgage. Um, I I did try ahead of this call to drill down on LO behavior before big data day, because we can track locks down to the hour if there were any trends there, but generally speaking, I think everyone knows the answer to this, but for example, on employment report days, you do see a huge spike in locks right after the report comes out, and then it kind of just levels off for the rest of the day. Um, what I will say, it is tricky looking at the data from a pricing engine perspective because it's hard to filter out what's like, if you've got a customer on your platform that hired a bunch of new loan officers, is that organic lock volume growth, or is that just because they added more bodies, right? Um, the data is tricky to kind of look through, but
Yeah, I would think Polly and the information that you provide your clients is is invaluable with regard to some of these metrics. So
yeah, we have yeah, I mean, because of the data that we collect just to lock a loan, right? We do have a lot of geo data on where locks are going, what markets are seeing more locks than others. But it's again, right? It's tricky to figure out the true meaning behind the numbers. Um, Rob Kessel, you had just talked about the risk of a single takeout investor. Crispin, I'll kick it over to you on this one. Are you seeing any new entrants to the market at all right now?
agency or non-agency? No. How about that for an answer?
Yeah, yeah,
No.
no across the board. I mean, on the pricing engine side, there haven't been too many requests to get new investor setups. It seems like it's a lot of the usual suspects. I'm just curious if you're
Yeah.
getting
I
more
mean,
chatter on that.
Ira would probably get hit up. But the only thing I've seen investor wise recently that I took note of was the Baltimore appraisal issue with appraisers. Now, this is just hearsay, I guess. I don't know what's been determined, but there was scuttlebutt that if somebody saw a bill or payment come through at $444, that was to be bumped up a little bit. But I know that investors, especially non-agency investors like eResi and others, backed out of that market entirely for non-owner, uh, non-agency loans. And I believe that AmeriHome, I think I saw a note recently, AmeriHome backed out as well from buying those loans in that area. So, but in terms of new investors like, Marcus Inc. coming along and buying what whatever, I haven't really heard of anybody. In fact, I believe that Discover just got out of what did Discover, Rob or Ira, do you know? Discover just got out of the reverse business or the HELOC business or something. Anyway, so Marcus, that's a long-winded answer to no, I haven't really seen anybody new pop up.
Yeah, I got it. Yeah,
Ira, have you?
No, I haven't seen anything come up. What about you, Ira?
I haven't seen any new investors. Sometimes on the non-agency side, you always get a new email from a new company. But in terms of the agency business or the government business, we haven't seen anything. But I did want to make a point. You mentioned having more than one takeout. We just mentioned the temporary interest rate buy downs. So using that as a quick example, if you hedged a loan that had a temporary interest rate buy down, and suddenly a rule was changed or rules clarified, and now your target investor suddenly throws a 75 basis point pricing hit on that loan that you hedged, you just lost 75 basis points on that loan. So having these multiple outlets, and that's just one small example, is always just crazy important. And even having those multiple outlets, if there's something that's sort of is a little outside the box, or you're not sure if one investor or multiple investors will take it, there's always the best effort options, right? So sometimes looking at those best effort options, if maybe you have even two outlets, might be a better execution than just hedging it and saying, okay, I'll worry about it when the loan's ready to close and we're ready to sell it.
Yeah, that makes a lot of sense. I was going to comment that if it's a one out investor, best efforts is probably the way to go, just for mental sanity and for exactly that reason. Um, I mean, on that subject though, like our this question, follow-up question for you, like how many investors on your roster would be like too many? Like at what point do you say it's not juice is not worth the squeeze and it's too much operational headache and you're getting F words thrown at you from the VP of Ops?
So it's interesting. So on the agency side, I always, years ago, I was like, okay, we have our, 4, 5, 6, we're happy with it. Nowadays, things have definitely changed. On the execution side, on the agency side, it's definitely manageable in terms of overlays. Things have definitely gotten a lot more streamlined. And as long as you can manage, soft overlays as opposed to hard overlays that'll be captured in your pricing engines, or when you go to do your loan sales, I don't think there's a really any hard limit to to the number of outlets. You never know when someone's going to have an axe. So I at this point, I say the more the merrier, as long as you can manage those overlays on the agency and government side of things. Now, on the non-agency side, there's a lot more variables with DSCR guidelines. This one needs reserves. This one needs 6 months. This one needs 12 months. So I think there's a lot more sort of you know trying to figure out where those loans fit, and those might be a little more of a struggle. Personally, we're locking those best efforts anyway. So it's more of that's where the operational piece is probably the bigger concern. But on the agency side, we're underwriting to Fannie Freddie and just managing the various investor overlays.
And are you seeing, just generally speaking here, for like non-agency loans, increased scrutiny on like post-funding conditions at all, or is it pretty steady, um, business as usual?
We haven't seen a specific increase on the non-agency side or even on the agency side in the last month or two. That's not to say, the loans you close now won't come down the line in 2 or 3 months, but we haven't seen any meaningful increases like in previous instances we have.
Got it. And then so Rob Kessel, I mean, let's say I'm a brand new, or let's say I'm a brand new customer and I'm coming to you saying I've got 14 agency investors and 10 non-agency buyers and a whole host of non-QM. Like, what would your advice or comment back to that customer be?
I think a lot of it depends on the loan sale technology they have. You can, to Ira's point, if you are very automated and efficient and have kind of two-step eligibility requirements that you can evaluate, and you can respond quickly to parceling out who won the total package. If your technology supports it, I think you can be in those double digits. If you're doing things more manually, then you got to weigh how much extra time it takes to make the decision and what you might lose by trying to have too many investors considered, and what operational inefficiency that might result in. I do want to come back one comment, just as a, a interesting observation from your data, Marcus, is all of these locks that happen right after non-farm payroll. I would just throw out to the listeners that, this is a perfect example when you might want differential, locks on your lock desk, time-wise. Basically the way the market responds and bounces around right after a non-farm payroll day, that's like a free money-making option for LOs, right? And, really, you don't want to necessarily encourage them to market time anyway. It's perfectly reasonable for many to say, hey, we're just going to delay the rate sheet for a couple hours and take that option away from the production side. Better for the lender. Maybe the LOs want to play the market a little bit, but just a gratuitous suggestion for those that aren't already doing that kind of lock desk hour differential.
Yeah, that's a really great point there, Rob. I will say I do know of a company that would use the alert to lock emails and texts that go out as an alert to raise margins. So something to think about there. Um, we got 4 minutes left here, Rob, Crispin. I'll kick one final question over to you and maybe go around the horn here. But we're at the start of Q3. What do you think are the biggest risks and opportunity to the back half of the year here?
First of all, I can't believe we're entering the third quarter. Time just seems to fly by. The successful companies that I've seen out there from a capital markets perspective, they realize, I think senior management and CEOs and owners and so forth realize that capital markets is a focus, a case study in consistency. I'm pretty sure Ira will agree that he does the same things day after day after day. And Rob, you see this with the academy, with your students and when you were hedging pipelines, just doing the same thing day after day after day, and not to get too antsy because, not trying to say, well, the Fed might do this in September, so I'm going to take this approach, or gee, non-farm payroll is going to come out, so I better, take off some hedges when it's not warranted. The success is due to protecting your margins the same way day in and day out and trying to get a few basis points here and a few basis points there. It's not a glamorous part of the business. And so, looking ahead to the second quarter, we don't know what's going to happen with Fannie Mae and Freddie Mac. We don't know what's going to happen with FHFA. I will say, as a closing note, that I continue to see originators and loan officers being able to add value by not executing on agency products. I continue to see them saying, well, we can go Fannie Mae and Freddie Mac, or, look, we've got this non-agency product over here that doesn't have the G fees, that doesn't have the loan level price adjustments, and the base rate is close or even better in some cases with non-agency. So they put the bar there. It'll be interesting for me to see as we go through the third and fourth quarters what kind of emphasis is placed on Fannie Mae and Freddie Mac and their viability and rumors of conservatorship, privatization, and so on, because the non-agency investors who are out there are really rising to the occasion. This is like their time to shine. And the price analysis, and Marcus, you probably see this. The price analysis points to the fact that for some portion of the business, non-agency makes more sense than Fannie or Freddie. And so I think as an industry, we're kind of watching to see what happens with President Trump and FHFA Director Pulte in terms of where, and Bessent, Treasury Secretary Bessent, where they steer the agencies. I think that'll be the big question for the remaining half of this year.
You got it. Thank you for that, Rob. Well, we're at time, and
Sorry.
yeah, no, that was great. I'm not trying to cut you off there. No, but that was a well spoken answer, way better than I could ever do. But anyway, thanks everyone for dialing in, and Rob and Ira, thank you as always for being amazing panelists.
And thanks to you, and thanks to Polly, Marcus. So muchas gracias.
Yeah. All right. Have a great rest of your week.